Three down, three to go. Ladies and gentlemen, my name is Greg Michalowski from ForexLive.com. Last week, we saw three central banks meet and made their rate decisions. The Bank of Canada raised by 50 basis points, which was less than the 75 basis points that was expected. Macklin said that he was getting closer to the end of the tightening, but they are not there yet, and added there is the emergency of some financial stress and some signs of underlying inflation coming down. The ECB raised rates by 75 basis points as expected, with Lagarde stressing that they were purposely not looking to give forward guidance and will be fully data dependent. Now, is data dependent inflation data dependent or growth data dependent? CPI inflation last week was much worse than expected. Manufacturing preliminary PMI was the lowest level since May 2020 and below the 50 level for the fourth consecutive month. The services PMI was below 50 for the second consecutive month and the lowest since February 2021. German IFO in Europe is the lowest since May 2020, and the GfK Consumer Climate Index is near the lowest levels on record. Higher inflation, lower growth. What is the data dependent going to be looking at? In Japan, they kept their rates as expected, but Ammon reported that a potential crack amongst the overall more dovish central bank policy. The Bank of Japan said underlying rise in inflation is likely to heighten medium-long-term inflation expectations and lead to sustained rise in inflation accompanied by wage gains. They also said that the BOJ will review ETF buying. It is small, but it's something. There's a little crack there. Now, on the other side of the coin, Bank of Japan's Kuroda in the press conference said that they will not hesitate to ease monetary policy even further if needed. This week, the Reserve Bank of Australia is expected to raise rates by 25 basis points, following up on the 25 basis point rise at the last meeting, which was less than the 50 expected. However, since then, the quarterly CPI came in higher than expected at 1.8%, which raised the year-on-year rate to 7.3% from 7.1% that was expected. The core measure also increased at a much faster pace than the expectations. The RBA did say that they expect inflation to get worse going forward, so it may be that they stick to the 25 basis point rate hike and move along that path. However, if they wanted to, they could go back to 50 basis points and front load the hikes. The RBA meets on November 1st. Now, the Bank of England meets on Thursday and are expected to raise by 75 basis points, although 100 basis points is not out of the question either. The BOE is in a bit of a bind as the new government won't propose a budget until November 17th. It was supposed to be on October 31st. That leaves the central bank in the dark with regard to tax and spending policies. However, I do know that the new Chancellor of the Exchequer, Jeremy Hunt, trashed the tax cuts from the Truss's brief stint as the Prime Minister. So with that backdrop, the thought is that 75 basis points is probably the sweet spot for the Bank of England to combat the 10% inflation in that country. So that leads to the Fed decision on Wednesday, the third of the central banks to announce their rates this week. The Fed is expected to raise rates by 75 basis points to 4% from 3.25% currently. That will be the fourth 75 basis point hike in a row, which is unprecedented in the Fed history. It will be the sixth hike in a row, which has taken the high of the target rate from 0.25% to the expected 4% this week. The terminal rate, as called from the dot plot at the last meeting, had the Fed target high rate in 2023 pegged at 4.6%, which implied a 4.75% top rate in the range of the Fed funds rate. The market is toying with moving that to 5%, but has backed off a bit as thoughts of going too far might do too much damage to the economy. Going to 475 implied an additional 50 basis points hike in December and 25 more in 2023, followed by a pause for the rest of the year. Is that still the plan? Is it still solely dependent on the data? how dependent is it if 2% inflation goal is not met? The Fed central tendency still had both the headline and the core PCE at 2.3% in 2024. In 2023, they had it at 2.8% and 3.1% for the headline and the core, respectively. That is on top of the gains seen to date. Anecdotally, a cheeseburger, a Caesar salad, and 2 beers came to $56 with a tip on Friday. The average car price is up to $48,300, which is nearly 24% increase in 2 years. Speaking to a friend in the construction industry over the weekend, the big mega cap infrastructure projects think the chip build from the chip infrastructure package are sapping resources from smaller projects and causing price increases. Caterpillar, being one of the biggest gainers over the last month, is indicative of the demand for construction materials. Inflation is not dead. What will Chair Powell and the Fed say on Wednesday when they make their decision on rates and express their thoughts on rates and policy going forward? So with that fundamental backdrop, let's take a look at some of the technical levels in play for some of the major currency pairs as the new week gets underway. Three down, 3 to go. So now let's take a look at the technical levels that might drive the currency markets in trading this week. We'll start by taking a look at the euro versus US dollar. I'm going to start by taking a look at the daily chart, and what in this chart, what we saw last week, we saw the price move up to test this 100-day moving average. That's a blue line in this chart. Also this swing area through here where the price had a number of different swing highs and swing lows, and swing highs broke above it here and failed, and then had reestablished that swing level in trading last week right near the 100-day moving average. That 100-day moving average currently comes in at 1.0077. And if a market should move above that level in trading this week, we should see further momentum to the upside, maybe move toward our 38.2% retracement of the move down from our high price that we saw back here in the month of January to the low price that we saw in the month of September. 38.2 comes in at the 1.02836. So again, breaking above the 100-day moving average in this swing area. We have traders looking toward this 38.2% retracement. That would be the move for in the upside for the euro versus US dollar. Now we are trading lower, as you can see on Friday, Thursday, and Friday. We moved down to retest this broken trend line right here. This trend line connected highs going back to the month of February through here, and then we had a high here, another high here. And we broke above it in trading on Tuesday and stayed above it on Wednesday and Thursday. And on Friday, we came down, tested the underside of that trend line. That trend line currently comes in around the 99 level. So think in terms of breaking below that level, opening the door to the downside, at least looking at the daily chart here. Also, we have this swing area through here, which is just below that level down to the 98.63 level. Move below that level opens the door for the downside. So on the top side, get above the 100 in this swing area, looks for the 38.2% retracement. On the downside, move back below the broken trend line here. We are closer to it, and break below the 0.9863 level, opens up the door for further downside with this swing area down here as another target. Let's take a look at the 4-hour chart, see if we can gather any clues from this chart. And here's our resistance against the 100-day moving average. See how clean that was up there as sellers leaned against that level. This area right through here where we have different swing levels coming in between the 0.98998 level. Again, that 99 level on the downside that we need to get to and through. It manifests itself here on the 4-hour chart. Break below that level and we start to look toward the 200 and 100 bar moving average on the 4-hour chart, which are coming near converged here, indicative of a market that's really trying to figure out whether it wants to go higher or lower here. When two moving averages come together like that, it's indicative of a non-trending market. We know we have resistance up there. We're going to have look for support down here on further weakness near those moving average levels. Let's take a look at the dollar versus yen. And the dollar versus yen last week tried to move to the upside, traded to a new all-time high not all-time high, but certainly the highest level, I think, to 19, whatever, it was decades ago. 151.938, the price moved above that level and then started to rotate back to the downside, had some intervention from the Bank of Japan through here, and then continued its move to the downside into Thursday's low, which came in around the 144.98 level, let's call it 145 level, before bouncing up on Friday. As you can see, we're starting the week a little bit higher and trading here today. So we are getting a bounce off the daily chart here near the 61.8% retracement of this last leg to the upside. Price couldn't get below that level, started to move higher, move back above the 145.90 level, which was the high price for the month of September. And we held that level on Friday at the low. You can see that right here, and compare that to this high right here. And that was a nice hold there. It gave the buyers a go-ahead to push the price to the upside. Let's take a look at the hourly chart and see where we stand in this on this perspective in the shorter term. And what we can see here is that the price traded on Friday above and below the 100-hour moving average, but toward the end of the day, we came down, tested the 100-hour moving average, found support buyers, and you can see in early trading in the Asian session today, we are continuing the move to the upside, keeping that 100-hour moving average as a level to eye on as short-term risk for buyers, and a bias defining level for both buyers and sellers. If the price can remain above this level, the bias remains more to the upside. We have the potential to move up toward our 200-hour moving average, which would be our next key target on the top side. Also, the 50% retracement of the move down from the high last week to the low last week, and that level comes in at 148.51. So 200-hour moving average at 148.41, 50% retracement at 148.51, 52. Get above those levels, and it's more bullish to the upside. On the downside, watching the 100-hour moving average for clues to the downside. Now, again, on Friday, we traded above and below it for a number of different hourly bars here, so we'd want to see the price trade below that level and stay below the level to keep the sellers more in control. If we can do that, then we have the potential that the dollar can actually get weaker and the dollar yen can get stronger, despite the central bank differences of opinions as far as rates go and the fundamentals that largely support a rising dollar versus yen. But technicals can make a play and can control the bias if they are allowed to, and getting below the 100-hour moving average and staying below that level would certainly be a bearish development for that currency pair. Let's take a look at the sterling versus US dollar. And again, I'll look at the daily chart to start off with. And looking at this pair, we had a number of, we've developed a nice little trend line through here, swing high. In last week's trading, we saw the price test that trend line, find willing sellers against the level, and push the price to the downside. Now, the push to the downside came down to a nice little swing area through here, where we have a number of different swing lows all through this period. Then we reverse the flow with the swing highs through here and here and here and here before moving above that level, that area in trading last week. The last thing that we did on Thursday's trade was move down to retest the top side of this swing area near the 114.949, and that level is going to be our close support level in the sterling versus US dollar to start the trading week. If the price can move below that level, again, this wasn't on Thursday, it was on Friday. Price can move below that level and then get below the lower end of this swing area at the 114.04 level, then the bias tilts more in favor of the sellers, and we expect to see further selling momentum to the downside as resistance against the trend line keeps a lid on the pair and forces the price back to the downside, just a normal correction. Of note here as well, in addition to the trend line holding right there, note here the 38.2% retracement comes right at that trend line. So not only did we have the trend line, but we also saw the 38.2% retracement hold resistance. That is key. That gives the sellers more control, and the buyers would need to get above both those levels in order to increase the bullish bias. Not far away from the 38.2% is yet another key resistance level, that being the 100-day moving average at 117.27. So a lot of resistance in about a 75 or 80 pip trading range, with the trend line 38.22%, 100-day moving average on the top side, needing to get to and through if the buyers are to take more control in this currency pair as it is right now. The sellers are leaning against those levels and putting a little bit more pressure or keeping the bias more to the downside with this swing area as a key level to get to and through in the new trading week. Enough said for that pair. Let's move on to the dollar versus Swiss. And I'm going to focus on the 4-hour chart for this currency pair, because I find it interesting trading between the 100 bar moving average on the top side, that's a blue line, 200 bar moving average on the downside, that's a green line. And as you can see, we found buyers against the green line in trading last week. We found sellers against the blue line for the most part in trading last week, with a little bit of a move above where the buyers tried their hand on Friday to move above that level, only to find sellers against the level, push the price back down in the last 4-hour bar right through here, keeping the bears more in control. At the start of the trading week, we're trading around the 0.99765 level actually, and which is just below the 100 bar moving average here at 0.99727 in our new trading week. The close level to get to and through to give the buyers more control is to get above this 100 bar moving average, break above the 50%, and then look toward this swing area where we have swing highs through here, and then we have some swing lows through here and some additional highs through here that put a lid on the pair in trading last week near the par 31 level. So 50%, or get above the 100, get above the 50%, which is near the parity level, and then start to work on the 61.8 in the swing area right here at 130 level, 1.0030. On the downside, stay below the 100 bar moving average, and we're going to look toward this swing area through here where we have swing low here, swing low here, swing low, swing low, swing low. Broke below it in trading last week and then tried to stay below it here. Couldn't do it, broke above it on Friday's trade. So getting below this 99.17 to 0.99299 level would open the door to the downside and look toward the 200-hour moving average with held support right through here. Our next pair that we want to take a look at is the dollar versus Canada. And if we look at this chart, I'm going to go to the 4-hour chart in this currency pair as well. What is significant in this pair is how the price held this 38.2% retracement a number of different times during last week's trading. We also was a level. It wasn't a 38% at the time, but it was a low level here before the price moved up to our high, created this 38.2% retracement there. So this area right through here where the 38.2 and these other swing levels come in around the 135 to 135.10 level, and we held that level and moved higher on Friday's trade. The 200 bar moving average on this 4-hour chart is we saw the price trade above and below it during Friday's trade, indicative of a market that just wasn't sure which way do we want to go. Do we want to go higher? We want to go lower? It deferred until this week, and we're currently trading around the 136.09 level, which is right at that 200 bar moving average. So no decision has been made by traders just yet, but traders will be watching that level to find early either sellers or buyers. On the downside, we got to get below the 135.62 and then 43 level on the downside to open the door. Then we're going to look at this trend line and then go look at the 38.2% retracement. Those are our close targets on the downside. On the top side, if we move above this swing area through here, which had recent swing lows, swing low, swing low, break below, and then use that level as resistance through here. So up to 136.66. If we get above that level, we'll look for the 100 bar moving average on the top side to be our next risk defining level and bias defining level. Move above that level and the upside channel trend line would come in play, followed by this swing area through here. And get above that, and we'll start to look toward the high for the year, the swing cycle high for the dollar versus Canada. Let's take a look at the Aussie versus US dollar next. And again, I'm going to focus on the 4-hour chart for this currency pair. Put a Fibonacci from our high to our low. The high price from last week sort of got near the 38.2% retracement. This is sort of similar to what we saw in the dollar versus Canada, where we held the 38.2. Let's go to the Aussie versus US dollar, and we didn't quite get to the 38.2% retracement here, but the pattern is very similar to that chart. If we were going to go higher, and we, obviously we're not near that level right now. But if we were to go higher in the new trading week, like for instance, getting above the 200 bar moving average here, 0.64539, we'd have to look and get through this 38.2% retracement and this swing area up here near the 0.65388 level. So those are the targets on the top side. Get above the 200, get above the swing area here. 38.2% retracement opens the door for further upside. But we are moving lower, and we are trading in between the 200 here and the 100 bar moving average down here. Those will be our risk defining and bias defining levels. Right now, the bias is more neutral with perhaps a little bit more swing to the downside because we had the opportunity to move above the 200, couldn't do it. So that was a failure, and we'd the preferred bias would be toward the 100 bar moving average, where we'd have to make up our mind whether we're going to break below that level and move toward our lows for the year, or we're going to find support against that level and start a rotation back to the upside. Those are two options for traders. So traders are going to be watching this level down here, watching this level up here, and seeing what happens, whether we move to the upside or we move to the downside for the Aussie versus US dollar in the new trading week. All right, and finally, let's take a look at the New Zealand versus US dollar. This on the hourly chart for this currency pair. Why? Because we came up and moved higher, and we found resistance sellers near our near the highs from Thursday and Friday. They formed this ceiling here and rotated back to the downside. I'm going to put a Fibonacci here from our low to our high price right here. See what the measurement looks like for this currency pair. Get rid of this one, and you can see that the 38.2 is down here near the 200-hour moving average. We also have the 100-hour moving average in play, and early Asian session trading came down to test this 100-hour moving average. We're going to need to move below that 100-hour moving average in the short term to give the sellers more confidence and to have the sellers try to push toward the 200-hour moving average. That would be the next major target on the downside. If the market cannot get below that level, buyers remain in control, and we could expect a move back higher with an interim move to this level right here, which was this old high through here, and then we'll get above that level and opens the door for a rotation toward our most recent cycle high here near the 58.72 level. So that's a look at some of our major currency pairs from a technical perspective as we start the new trading week. Hope that you find the week very profitable for you. Good fortune with your trading. My name is Greg Michalowski. Bye-bye now.